Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about this growing trend of build to rent. Okay. How it is affecting the housing market and why it's going to make the housing shortage worse for people who are trying to buy.
That makes sense.
All right. So I have a bunch of data that I gathered for this. So we're just going to sort of jump right into it.
Okay.
We're going to also talk about maybe the next multi-year outlook and what we would have to do to get to where we have more equilibrium in the market.
Okay.
We have shortage in the market, right?
Mm-hmm.
Okay. All right. So here's the first article that I'm referencing on this. It came out of, it was JP Morgan Chase. Fundrise, which is a company, prepares to expand their build to rent, that's what BTR portfolio, with a $770 million boost from JP Morgan Chase. They're going to develop 35 build to rent communities across the Sun Belt.
Wow.
Okay, first of all, let's talk about this. Now, I don't know how many total houses this is, but 20 years ago, this didn't exist. No home builders would not, banks were not going to home builders going, I want to buy the whole subdivision. Right. Okay. Why? First of all, let's talk. Why are they doing this now? What are these banks and these big funds seeing in real estate and about owning rentals that other people maybe aren't seeing?
So they're seeing the trend of insufficient inventory, elevated demand, and they're also seeing that there's this whole movement because of interest rates, because people are starting later in life, because of a lot of different reasons. People are tenants, and they're tenants longer than they've been in previous generations.
If you were going to guess, so 35 built to rent communities, 770 million. I'm guessing that's a few thousand homes.
Sure,
it would have to be.
It would have to be. I mean, at a guess, even if each community had, let's say, 150 homes, that's still, well over 5,000 homes.
Yeah, that is. Okay. If you had to guess nationally what the estimate of build to rent homes are in any stage of development, around where would you, given that there's only 700,000 homes probably that are going to be built, single family homes that are going to be built?
That's a great question. Wow. That's a really great question. So, I don't know. I don't have any data on this, and I don't even have a place to start my guess, except for the part where, we're seeing anecdotal information like this.
Mm-hmm.
So if we're looking at 700,000 homes being built across the country, then you have to figure that, even if it's, a couple percent, even if it's 2 or 3%, that's still going to be quite a few homes that are being built for build to rent that are not going to be available for people to purchase. And it's an environment where there are so many more people interested in purchasing than homes that are being built.
Okay. Here we go. Here's the number that I was able to find.
Oh, wow.
It says folks need shelter. They don't need to own that shelter. As a result, the build to rent market is exploding.
Okay.
There are nearly 500,000 build to rent homes nationally in some stage of development.
Oh my gosh.
500,000, some stage of development.
Wait a minute. Wait. Hold about. So we're going to build 700,000 homes this year.
Mm-hmm.
And 500,000 homes are slated to be built over the next few years.
I don't know. I think this is a multi-year carryover number.
Which is what I'm saying, over the next few years.
Yeah. I would say if you asked me, 20 to 25% of all homes being built. The problem is we don't see them because it's not like they put up a sales office. The builder just goes out and builds subdivisions and then they just stick tenants in them when they get the time. Now, naturally you would think, well, what's going to happen is all these rentals will flood the market and crash rental prices. But actually, it's not true. But because we're not building homes for people to live in, we're making it harder for people to buy homes. So we're actually forcing more people into rentals. So we're basically, by taking away the house they would have bought and forcing them to rent, we're not actually dumping more rentals. We're just changing whether a person rents or buys, right? That's what these companies are doing.
They are. And like I've said before, I think that at some point these companies will go ahead and transition from rentals to sales, and that they will just sell within their community to their residents and that sort of thing, I don't think you're going to see these homes hit the MLS and impact the MLS in that way. So of course they will impact the pool of homes, because if people have the opportunity to buy the home that they're living in, they're not purchasing another home that might be on the market. So it does impact it, but it's not going to be as dramatic as people think it is. And because it's going to be over time, and because it's going to be obscured, because these homes won't actually hit the market, it'll be a lot harder to track the effect of these homes.
Okay. Rent prices were up 2% in February. It's the biggest increase in over a year. Median rent is now around $2,000 per month nationwide. It's about $2,200 here in Vegas. $2,000 a month is around the monthly payment on a $310,000 home loan with today's rates. If you're in San Diego, you can probably not get a house for $310,000, right? You might be able to get a small condo. Bless you.
Thank you. Sorry.
In Vegas, you can get something, but it's more likely condo, and extremely, like some of those attached houses. We just had somebody buy a house for $350,000, and it's a small attached house. It's a single family home, but it's just attached to another house.
Right.
It's like two houses stuck together.
And it's taking about $50,000 in renovations to make it decent.
It's actually probably it'll be worth $400,000 when it's done, right?
Right. Well, so it'll be, they'll break even, because between what they paid and what they put into it, they'll just bring it up to market value.
The problem is right now we have a lot of people saying I can't afford to buy. If you have cash, all you care about is the price of the house. What is going to happen, do you think, if rates, say, in 2 years go back below 5%?
Pandemonium.
Okay. Why is that? Let's talk first about explain to them the build-to-rent homes that aren't being sold.
Right.
All the other homes owned by institutional investors aren't being sold. All the cash rentals that people have been holding on to, people that live in their homes that just don't want to sell them or have a super low interest rate. What does that mean to the actual available number? We have 140 million homes in the U.S., but they're not all really available because some people are just not selling, right?
Right.
So how does that work? Explain that.
Well, so what's going to happen is, as interest rates go down, you're going to have more people all of a sudden be interested in buying, because now the spread between what they're paying in interest on their current loan and a new loan isn't that great. And you can have people who just see money at a discount, and they're going to be very happy to participate in that. You're going to have people who maybe missed the opportunity the last time around. They don't want to miss it this time. So you'll have all these different groups of people wanting to participate and purchase homes. So what that does is, again, we already have diminished supply versus the amount of demand that we have. So no matter how much supply we have at that point, we will still have an excess of demand. And what that's going to do is naturally push prices up. So the people who are paying, let's say, $500,000 today, if interest rates go down to, let's say, 4%, then that difference in that mortgage payment is going to actually go into the seller's pocket, because that's going to be the premium to purchase at that point. So the idea that, that $500,000 house today, it'll still be $500,000 in 2 years from now when interest rates are 4%, doesn't quite work like that way. And that happens every time, because we have this kind of interesting dynamic in the U.S. A lot of people are more focused on their payment than they are on the price. So that dynamic is kind of what drives the current situation with interest rates. Because if we weren't as focused on the monthly payment, then the current interest rates wouldn't mean as much as just paying a fair amount for the property.
I'm going to disagree with something you said.
Go for it.
I don't think most people only look at it as a monthly payment, and this is why. I think the press likes to promote this because it gets clicks, housing affordability, and showing how hard it is to buy a house and everything. You have 42% of all homes are free and clear. You have a lot of people who are putting a lot of money down. You have high income earners that I know that are paying, their mortgage payment is like 10% of their annual income. It's not that they don't really care that much. They like the house, they bought it, they make a lot of money. It's not that big of a deal. I think it's kind of ridiculous for when I see these articles, because if you're, if people, when I hear somebody say I'm waiting for homes to be affordable again, well, if what you mean is the monthly payment to be affordable, if the monthly payment is affordable for you it's going to be affordable for another 5 to 10 million people. And then those people are all going to be trying to buy houses when you're buying a house. And if it takes 2 years, those over time, because think about it, every time interest rates drop a little bit, some more people are able to come into the housing market. And then more people. And you see with Todd. Why then, when interest rates went up, because we had all the crash bros, we're saying home prices fall 40, 50%, it's going to happen almost immediately. Like tomorrow, when they'll have to drop 40, 50% to sell. It never happened. And the reason it didn't happen is because we have this structural resistance to changing of price. Plus, you have a lot of the market that's locked up by super low loans. Everyone who's had a loan for the last 10 years pays less than probably 5% at the most. If you bought a house for the last 10 years, you don't pay more than 5%.
Most people, yeah.
Yeah, or you're free and clear. Right. Here's another thing. Rent prices are up for a year ago in 47 of the biggest metro areas. Highest was Providence, Rhode Island, with annual increase of 7.7%. Now, it's not up in every market. Nationally, though, rents were up 2%. And I mean, Chairman Powell even came out. He had a quote. I have the quote here. He says, Federal Reserve Chair Powell told Congress that he believes the housing market is undersupplied, okay, and will remain that way for years to come. The housing shortage, low inventory will be with us for a while. Juana, do you think this means that the undersupply is transitory?
So, no, I don't think the undersupply is transitory. If by transitory you mean of a short duration. I think this is a long systemic issue.
Okay. Here's another problem. We have people not giving up their house.
Correct.
We have people immigrating. We actually had 3 million births. We had over 3 million births last year. It was a huge year for births, over 3 million births. Who knows how many people came in the country? Probably 5 million, right? Because we can't count the people coming across the southern border. So that's probably 8 million. We had 300,000 baby boomers die.
Okay. So one thing that I want to point out for those who say, well, the people coming across the border, they're not buying homes. And I don't dispute that. But what I am saying is that these people need homes to live in. So that means that somebody is buying homes for these people to live in. They're renting, they're whatever that they're doing. So just because they're not buying homes doesn't mean that somebody else isn't buying homes and these people are not renting them.
I have a theory
Yes.
about the wealth effect of all the people who have been homeowners for probably the last decade.
Okay.
Traditionally, when I go back to the 80s when I bought my first house when I was in the Marine Corps, I was making like $1,700 a month as a second lieutenant. And I had a monthly payment of about $550. So it's like close to a third. It was a little less than a third of my. And I expected that any house I bought would be, a quarter to a third of my income.
Sure.
And then the rest of my income I use for everything, my car payment or buy food, whatever, living expenses. You don't have a lot of living expenses in the military. Sometimes you live in base housing or something like that. And when you're young, you don't have kids, it's sort of easy. You can get by on, so after taxes, I made like $1,100 a month, other than housing expenses, right? Okay. Now, moving into the future, take those same people who basically only had enough to spend to get by, and now take into account that they either have zero mortgage payment or they have a very low mortgage payment compared to their income. Wages have been rising at 4 to 5% a year for the last 4 or 5 years. Real wages are up 30 or 40%. Like wages are up, people are making more money. But their housing costs, their fixed cost of their housing hasn't changed unless you're a renter, unless you're a tenant, right? If you're a tenant, every year you pay more in housing expense. So if you bought a house 5 or 6 years ago, you refied it 2021, you probably have $1,100 a month payment. And today, if you pay rent, you probably pay like $2,000, $2,200. You pay a lot more. So what are people doing with that extra money? Like literally, I believe people have extra money that may be helping with inflation. The zero interest rate policy obviously helped individuals take a lot of their long-term debt and make it super cheap and then lock it in at really low rate.
Right.
So do you think that affects housing? from the perspective of they can have this lifestyle maybe. They can buy all these things because the house is a cash cow. And the second they sell the house to move to, Tucson, where their kids live or whatever, they have to give up the cash cow and go back to being a little more strict.
Right. So I think, two things. First of all, I agree with you that people have gotten accustomed to their low mortgage payment, and it's very hard to give that up, particularly if you have to pick up a higher mortgage payment. But some people will use that opportunity to, because they've got a low mortgage payment, maybe to extinguish that loan, and now they've got the house free and clear. So that is a possibility. So maybe when they're moving, to your point, to Tucson to be closer to kids, maybe they can basically swap houses where they sell their house wherever they are, and then they buy a house for a similar amount of money at the new place, and so they don't have a mortgage payment over there either. So that's a possibility. So, and then the other thing is, I think people, to your point, have become accustomed to having a cost for housing that they can easily afford. And it is hard to give up that luxury. And I do mean that. I think having a home that you can easily afford is a luxury, and it's a wonderful luxury. And it gives people the opportunity to do other things, like, for example, travel or invest or contribute to their kids' education, or for them to maybe get an education, whatever that is. So I think those are really important things to point out, that the wealth that was created by freeing up people from paying higher interest rates and allowing them to have these lower mortgage payments is money that is chasing goods in the economy, whether those goods are, like I said, travel, luxuries, education, whatever that is. And so I think those are good things.
I think that is the reason. Here's the article. This is actually from jpmorgan.com website. February 2024 jobs report, 275,000 jobs added, higher than forecast. This is because people when they spend money, they create demand, meaning they create, they add to demand. And when companies see more demand, they ramp up their operations. If more people are going out to restaurants, they expand the hours, they build a new location, or, they do some other thing. Or if some, maybe home builders or build more houses or whatever, and this creates jobs. So we have everything showing sort of that more jobs are being created. They've been created every month now since, I think, late 2020, right? Job growth is just job growth. But I think a lot of this has to do with, you can't discard the people who have super low fixed housing payments,
right,
and how much money they now feel like they have to go spend on it, whatever. They're going to go to Costco and buy that thing they never bought. And then you go to Costco and they're out of the thing that you just found out about because, they're $40 each, but now everyone can afford it.
Right. The other thing to keep in mind is that all of this is not out of the realm of people who are paying attention to the economy. So people like in manufacturing or in the Federal Reserve or government in general, they are tracking all of this. And this is why they're being so cautious about the interest rates, because you have all these businesses that are just poised to increase production and to hire more people and produce more goods and services and that sort of thing. And all of this plays into that whole into the whole dynamic of inflation. So the Federal Reserve is watching this. They are having conversations with people in various industries to see what their plans are, so that they can get a better handle on what's on the horizon for the economy and be able to plan and have the interest rates guide the economy in the way that the Fed would like, which is with nominal inflation and not so much volatility in inflation.
I think the one thing that will not meet the excess demand is housing. I think we will underbuild homes. We're creating 2 million households a year. We're not even coming close to building enough homes for 2 million households a year. I see there's probably way more effort. You know this because we're in the middle of a bunch of like flips where homes are being renovated and fixed up. There's more activity going on in fixing up homes than existing homes. than there is in creating new ones.
Right. Well, but that's normal, of course, because remember, we have far more aging inventory than we have new inventory, which is natural.
Yeah.
So because we have so much aging inventory, people are choosing to invest in the aging inventory and renovate it, bring it up to reasonably modern standards, and there is a return on investment for that. The return on investment is actually not specifically very great, but it certainly is enough to guide investors to do that, particularly in an environment where they have no other opportunities to buy homes because new home builds are expensive. They're hard to get because there just aren't enough of them being built. So resale makes more sense for them. Okay?
Yep.
All right. So please remember to like the video and subscribe and hit the notification bell. Of course, please leave us your real estate related comments. We appreciate your comments. You don't have to agree with us. We just appreciate the conversation.
Yep.
And we appreciate you liking the video and sharing the video. We'll see you on the next video. Bye.
Bye.